afternoon, everybody. Thank you for joining us today on this beautiful sunny day. It's that first spring day after the long winter wait, excuse me. My name is Brian Lockett. I'm one of the lead advisors here at Comprehensive Wealth Management. For those of you who do not know who we are an elite boutique investment, tax, and estate strategy firm specializing in financial planning. With me today, as always, is our Chief Investment Officer, Morgan Arford. And we have a guest speaker who flew in all the way from Chicago just for our clients today. Thank you, Chris, so much. Chris works for First Trust. He's one of the VPs of research and actually runs some of their actively managed ETF portfolios. And he's been doing this for over 18 years. So his opinion, let's just say, counts. All right, today's agenda, for those of you who have been to our third leads and our webinars, it's no different than it always is. We're going to review a lot of information. That is a promise. Morgan's going to take you through a brief CWM commentary, and I mean brief. Actually, Chris is going to be the star of the show today. I know a lot of you crave Morgan's squiggly line charts, but for those of you attending the dinner, you might get a bigger dose. Now, he's going to take you through CWM's model and data review. And he's going to talk about extensions and, of course, the elephant in the room, the tariffs. Where are we really headed? What is the impact going to be? And then we're going to kick it over to our featured speaker, Chris, who's going to take you through First Trust's perspective on markets, which we are very interested in hearing as well. And then we will close out with some upcoming events, and we'll go through some Q&A as well. And with that, Morgan, let me kick it over to you.
All right, well, thanks for taking the time to come here. We have to say today, guys. I'm going to go through this really quickly because our friend Chris here is on a time crunch. And so I will present each of these slides relatively fast. I want to remind everyone this is going to be recorded and will be put out to you all probably later this week, where you'll be able to go back and look at anything you want in more detail, pause it, rewind it. So sorry for the speed today for those of you who like it want to go a little bit slower. Where we always start with everybody is recognizing where you are in your own lifespan, where you are in your own needs. Are you early on in your phase of accumulation where it is, saving and investing is the most important? We have a strategy for you. Are you in the middle of your career like Brian and I are, where saving and investing is still important, but you need to start protecting some of those assets you have because they're getting harder and harder to replace as that pile gets larger. And of course, if you're needing to live on those assets in retirement, you want to protect those things. You want to make sure that they're there for you, to provide for that lifestyle that you dreamed of and you worked so hard for all these years. All these different strategies have different bents, have different biases towards risk or being risk adverse. We'll talk more about that here in a moment.
Morgan, I wanted to add something there real quickly. So the reason we talk about this is that we're going to take you through a lot of information, and each one of these strategies is going to respond differently to that information. The wealth accumulator model, it's not going to care about anything we're talking about today, to be perfectly honest. Whereas the risk adjusting model, I should say, cares the most about what's going on. So where you're at in that journey dictates how much you really care, how much you should really respond to what we're going to talk about today. And that's why we talk about this investor life cycle. Very important to know where you're at in that life cycle.
Yeah, very important. So what we know about markets, and what this chart is very busy, so I'll explain it to you very quickly. What this chart shows is the outcomes for the S&P 500 every single year going back to 1980. You notice that most of those bars end with a positive number in the gray or kind of darkish gray area. Average return in that space is 10%. In order to get that 10%, you have to suffer an average entry year drawdown of 14% on every given year. So each one of these little red dots, that's the worst top to bottom drawdown each of those years. So what that means is if you're going to try to get this 10%, you have to be willing to suffer somewhere in this range. And really, I put that more into a range of, call it 7 to 20% is really the range of normal market losses. What we truly worry about are those debilitating losses, the 30% plus that can really set you back. Those of you who've been on these webinars before will remember this. We hit this point every single time because we think it's key to understanding basic investing. The reasons we emphasize that 30% is anything less than that, you're essentially getting back what you lost. Once you get over 30%, those losses become exponentially harder to recover from unless you're putting in meaningful new contributions. So again, if you're earlier on in your investing career and you're putting in a lot of money relative to your portfolio size, you don't need to worry about this so much. But if you're near retirement, these losses could be the thing that sends somebody in your family back to work, and we want to make sure we prevent that for you if you are in that part of your life. The most basic way to do this is controlling the asset exposure. If I have 100% stocks, typically the most volatile investment assets you can own, at least on the publicly traded sphere, your range of outcome can be fantastic to terrible, with an average gain that is the best of all the asset categories that we look at. If I decide to go 100% on the other side, the things that are typically, and I say typically because it's not true in every single year, 2022 being an example where it wasn't, typically are stronger performers on downside market environments, your range is smaller, but so is your average return. And the way we utilize this for client portfolios is in those models we discussed earlier, biasing your portfolios more or less to those different areas. If you don't need to take a lot of risk, if you need a relatively low level of return to stay well off and happy, you could look at a money market paying 4.19% right now. But if that's not enough, I need to increase my risk tolerance and exposure to things like stocks. So basically, the farther up and to the right we go in our portfolios, you'll see all those acronyms from earlier. The more risk you're taking into your portfolios, the more biased you are to market exposure. The way we build all these things out is at a macro level. Do you want stocks and bonds? What mixture of stocks and bonds? And then also at a micro level, what stocks, what bonds? This is where our friends at First Trust often come in, because we put them into various categories where their products are shown to be superior to their competitors, or at least we believe them to be, at least on our research. That's also established for our active models via data analysis, as we call our CWM factor wheel. Many of you have grown to love this thing like I do. This is a great way to visualize, hey, what does the market environment truly look like? In the current situation, the economy is actually all right. I'm going to give this a positive. We're seeing some expansion in a lot of places. Market momentum is to the upside, other than the very short term, which has turned negative because of the performance of the S&P so far this year. Interest rates, this is kind of a neutral to kind of negative environment. It's negative because we have sharply higher interest rates than just a few years ago. Those of you looking for a home right now know what I'm talking about. It's a lot harder to afford a home right now. We also still have some yield curve inversion, which historically suggests that we're going to see a recession in the relatively near term. Investor behavior, this has actually gotten a little better. This is a measure that we use to say, are investors being greedy, meaning we should be more fearful, or are they being fearful, meaning we should be more greedy? As investors, we want to do kind of the opposite of what general sentiment is, because Americans and investors generally hate to buy what's on sale because markets have been declining, and they want to buy the things that have already done well, which is the opposite of what you should do as an investor. You want to buy low and sell high, not buy high and sell low. Behavior has gotten a little bit better, but I wouldn't call it a level that's truly interesting yet. Valuation is truly the biggest threat right now, because we are still near all-time high levels of valuation, even after a significant 10% drop on the S&P 500. To emphasize some examples of some of these pieces, here's our favorite measure of valuation: market capitalization to gross domestic product. Think of this as the combined value of the entire stock market divided by the economic output of the country. At the highest level back in February, we were over 3 standard deviations above the means, a market with 2 times the economic output of the country. Now, for those who don't speak stats, what that means is we're seeing an outlier you should see almost never, and you can see the history back to 1972. We've never seen a level of valuation like that. It's extremely high, and we've seen a pretty sharp sell-off to the level we're at now. This is still really high, guys, at about 2.5 standard deviations. Normal doesn't exist until we get to around 1 standard deviation. That's where we would say, hey, now's a decent time to start buying in stocks based on value. They're reasonably valued. That's a 33% decline from where we are today still. Brian, your question? Okay, got it. Good. I didn't
That was
forget.
the question. How far out do we have to go?
So again, this is just one factor. It's just not saying markets are going to fall out of bed just because things are expensive. What it is saying is that markets are more fragile because they're expensive. You have a higher risk of a significant drawdown. Now, valuations across the board aren't as expensive as they are for the S&P 500. The S&P 500 on the forward PE basis is right here, and it's 95th percentile of expense. But there are areas like international equities, non-US equities, that are actually reasonably priced right around their average. Think below that 1 standard deviation level I was just talking about. There are even US areas like mid caps, which we just added for some of our equity models, that are also reasonably priced. So you can find growth at a reasonable price, you just got to look a little bit beyond the S&P 500 to find it. And of course, our favorite category for our risk adjusting models, those of you who are trying to preserve assets over growing wealth, fixed income outside of high yield bonds is actually at reasonable levels, paying reasonable income. So we feel very comfortable in those spaces too. The point is that while markets overall are fragile because of high valuations on the major indices, there are areas, if we dig a little deeper, that we can get involved with. On the economy, 8 of our 11 leading indicators, our leading economic indicators, are actually headed in the right direction. Note that leading economic indicators as a group are still negative. So while we're seeing the economy improving, we are still in a range that typically you see recessions. Note the current level where it dropped down to is the only time we haven't seen a recession where you've seen leading economic indicators fall like they have. So this is truly an anomaly. We're not out of the woods yet, but getting better is at least as important as where we're reading currently. So that improvement's important. One of those big positive components is earnings. What we see over the last 5 years, the last 2 years, is earnings are continuing to grow, and that growth is accelerating. If companies are earning and increasing earnings, it's really hard for stock values to go down. So in this way, they're kind of justifying those high valuations because we're seeing large levels of earnings growth. That said, we could end up with a sharp market decline, even sharper than we've seen already, even if we don't see a recession. And recession is still technically a possibility. If you get a recession, typically your declines are worse and they last longer, but we can still see an average decline of 21% from all-time high valuations, or we can see just a normal decline of 15%, which would be just a little bit worse than where we are today, and right in line with our average annual drawdown. Our bet currently is that we are in this average space, which may be exacerbated because we're in a situation of all-time high valuations, which tend to lead to worse market sell-offs. But we don't necessarily get a recession to go along with it, maybe. But what we do with all this information is we do bias or position our models depending on their own inherent biases to more or less conservative positioning. If you're in our risk adjusting models, our goal is income over portfolio participation. Beta is a measure of correlation with the S&P 500. If you put beta 0.39 says my portfolio is going to move less than half of whatever the S&P 500 does up or down. If in our wealth accumulator models, which is CWM's way of doing low cost indexing, our beta is 0.96. I'm going up and down with the market, and I'm getting a much smaller yield than I'm getting in my RAND portfolio. The way to think about this simply is the more conservative bias my portfolio is, the more income is a primary component of return rather than principal appreciation. You might also notice that the tactical allocation models, TAM, is relatively similar beta than the WAM models, our indexing portfolios, but they have higher income. Even though they have similar readings, the underlying allocation is very different. We have a lot more international exposure in our active models. We have a lot more precious metals exposure in our active models than we have in our index portfolio, which is much more US centric, much more of your traditional buy and hold portfolio.
Morgan, I wanted to make a clarifying point on this page, which is the strategies in orange are our active strategies. They're the ones that we're going to be making changes in response to the information that Morgan just took you through. So while you see a beta of 0.39 across the board on all of the RAM strategies or RAM portfolios there, that's not going to be forever. Eventually, they will return to their bias. If you guys who are on the webinar understand what we're talking about. And so this is a fairly short-term thing, whereas the wealth accumulator models, those are not going to deviate. They're not responding to this information, as I said earlier.
Good clarification, Brian. And I want to make sure that all of you know that while these strategies are intended for certain segments of your lifespan, they really are available to you depending on what you need and what you're looking for. So if you decide, hey, no, I have a mostly RAM adjusted model money, but I really want to have some models exposed to just an index product, we have that available for you. That's perfectly fine. Brian or any of the advisor team can walk you through that, make sure it's appropriate for you. Brian, you want to?
I actually want to comment on that. A very common structure that we've seen lately is a lot of our clients who are in that retirement phase. They're in the preservation, distribution, and some accumulation. Remember the far right of that investor life cycle chart. They're in the risk adjusted models for most of their money. But then some of the clients have enough money that they're like, this money is next generation money. This is legacy money. So we're kicking that out and we're being more aggressive with that, with the or the tactical allocation model and the wealth accumulator models to, and just let it ride a little bit more.
All right, moving on to what is probably a more pressing matter to a lot of you, and I'm going to cruise through this too. I want to make sure to remind everybody we are recording this. It will be out in a video later this week. You'll be able to replay sections that I move through too quickly and pause it and take a look at these charts a little bit more. But I know everybody wants to know about two things: what's happening with taxes and what's happening with tariffs. I'm not going to read through every aspect of this piece, but we do know that they're going to that Congress and the president are trying to push through an extension of the 2017 Tax Cuts and Jobs Act. They're trying to find ways to cut spending and raise some taxes, but net effect overall is you're going to see a relative $2.5 trillion increase in the deficit over a number of years. This is a big deal because with that extension, we go from an already bad deficit spending situation, debt to GDP situation, to an even greater debt to GDP situation. The general estimate is that we can sustain deficits until this number reaches about 150% debt to GDP. So this is going to be a problem. It's going to be a problem sooner if we don't control spending or find new revenues or some combination of the two. On tariffs, tariffs is a big concern. What's going to happen? Is this justified? What this chart is showing us is actually the majority of the world, all these red dots, has greater numbers of tariff or greater volume of tariffs on our products than we do on theirs. Note though, the U.S. current tariff policy is so far targeted China, Canada, and Mexico. Next week, we're expecting to target a lot more of these other players in the space, as the president believes and his cabinet believe that raising tariffs will increase U.S. competitiveness across the world, will encourage people, businesses, to come build their factories and start their businesses here domestically if bringing products and services in from outside the country is more expensive. I believe they also are ideally trying to eventually lower trade barriers across the world if everybody agrees to drop their tariffs simultaneously. I think that's going to be a very difficult thing to achieve, but wouldn't it be wonderful if it occurred? One advantage the U.S. has over most of the rest of the world, or developed world at least, is the U.S., this line with the triangles, is much less trade dependent as a measure of GDP, gross domestic product economic output, than it is other countries. Notice Germany, very dependent on trade. We have Mexico, one of our trading partners, very dependent on trade. Canada is not as much, but still much more dependent on trade for their economic activity than for us. A tariff war breaking out where everyone has tit for tat raising tariffs is much more damaging for these partners than it is for us. It's still not great for us. It still is probably GDP negative. And that is the estimate that our friends at Goldman Sachs essentially put out. If we raise tariffs up to the level currently expected, and then possibly get into a trade war that ends up with higher tariffs, that is a likely GDP negative, somewhere between 0.75 and 1.25% negative on forward GDP growth. So there's a lot less economic growth going forward, lower GDP in the future than otherwise would have happened. Well, what about inflation? Well, we end up with that nastier trade war scenario. You can see inflation, be almost 1% higher than it otherwise would be without the tariff situation. I do want to point out, however, that in the estimates that Goldman put out, any inflationary pressure is still expected to be short-lived, but that is a problem for the immediate future. You could have a lower economic output and higher inflation at the same time, which is the definition of stagflation. Not typically a good environment for markets, not good environment for company earnings or values, especially at all-time high valuations. And that economic uncertainty, well, that's typically associated with uncertain times. The COVID crisis here in 2020, the 2008 great financial crisis, those were not good environments, at least not in the short term, for stocks. Eventually, though, they did end up being good places to buy assets if you protected your capital. I want to finish this discussion on the optimistic view. What happens if it works? And Chris, I'll put this to you. Maybe you have time to touch on it. What's the optimistic case if things actually do work out? If we do see tariff policy succeed and end up lowering trade barriers across the world, we could end up with a short-term decline and a positive outcome over the long run. But you can bet between point A and B that there will be a lot of volatility, even if, and I'm going to say if, it succeeds. For clients who don't need to take that risk, I have an answer for you. Clients who don't need to care about that risk, we have an answer for you. Clients who need some variation of those two areas, we have an answer for you. Talk to your financial advisor team. Remember to try to focus on what you can control. We can control your portfolio risk. Savings is really up to you, how much you can save and invest. Time and behavior, that's a factor of what you work on with your advisor team. We cannot control returns. We can only position ourselves based on what you need and what you can tolerate. And with that, I'm going to hand it over to Chris.
Perfect. Yeah, I thought that was an excellent overview. I loved the first slide where it shows the average drawdown is 14% throughout a year. And so when I look at, back up, I'm going to talk about equities today. It is a risk asset. There's volatility. I thought that Morgan and Brian did such a good job of showing you, look, the last 2 years where the S&P was up 20+% each year, right? The broad market averages were up 20+%. That rarely happens. The last time that happened was the late 90s, and we all know what happened after that. But the way, look, trying to call the market in the short run is really difficult. And that's why I loved how they showed all those different risk buckets that you can go into, because the market is a volatile asset class, like we're seeing this year. But I want to focus on today, what do I see from the market? And the high-level takeaway is it is a mixed bag, a lot like they showed their circle there with all their different drivers. I look at it very similarly. If I look at it, I have 3 key drivers that generally tend to drive the market over time. Number 1 is sentiment. We will get into that. It's gone from very high to very low in a very quick period. That's generally good for equities. We'll talk about interest rates. Generally, lower interest rates are good for markets. Like Morgan said, a little bit mixed there too when you look at it, because rates have come down. But if you're trying to buy a house or you are trying to buy a car, things are higher. So that is a little bit of a glass half empty. And then lastly, though, the one I always love to look at is fundamental earnings. Because at the end of the day, when companies are making more, just like if you own a small business, you're making more, they should be worth more. And so that is the good news, is companies are still doing rather quite well in the U.S. But let's jump right into it. So what's been driving the market as of late? It has been sentiment, extreme negative sentiment as of late. So I always like to look at the AAII Bulls Bears survey, and it comes out weekly, and it's just individual investors like yourself, how you're feeling about the market. Now, unfortunately, my slide is from the end of January because compliance hasn't got my slides updated yet. But if you look, we've just exited a 3-week period when less than 20% of investors like yourself were bullish on the market. Now, what's interesting, and Morgan touched on this, it is a very good contrarian indicator. So if you actually see over time, if a lot of investors are bullish, more than half of individual investors like yourselves are bullish, stock market only tends to go up 4% over the next 12 months. Now, where we are today, I am not calling for the S&P to go up over 20% over the next 12 months. But historically, when you've gotten this extreme level of bearishness on the market where investors have been fearful, it is generally a great time to buy. So I would say is, look, actually right now, you've seen a nice little snapback in the market. I do think you got a little bit too much of the extreme of the negativity on the market. Another stat I love to follow for sentiment, and this is a really interesting one to me, is speculative tech stocks. So this slide's a little bit old. It's a couple months dated, but this is also one of my favorite sentiment gauges. And why is that the case? Because if you have technology names, and there's a lot, we're in a backyard of some amazing tech companies, right? I'm not talking about Amazon. I'm not talking about Microsoft. But these are technology companies that don't make money. What you saw in the fourth quarter last year was extraordinary. Huge run up in names that were like quantum computing names that didn't make any money. And so one of my big things with investing is always sentiment can change overnight. You do want to focus on the fundamentals. But what's interesting is, like we saw in in the COVID boom, where the Zooms and the Pelotons did really well on a relative basis relative to the S&P. We saw that in the fourth quarter, and there was a lot of what I would actually consider a lot of froth in this market where, yes, there's some really good AI themes out there. There's some really good companies, but just like the dot-com bubble where there's names like toys.com that weren't in good investments, you're going to see that again this time around. So what you've actually seen, and if I could update this, the last 2 months, you've actually seen this line come down quite a bit. So sentiment has changed a ton in a very, very short period of time, which I actually think is good for the market. Number 2 key driver. So sentiment's good. Number 2, interest rates. Very interesting from where we sit today. We've gotten some rate cuts, which is stimulative. However, you look at this year, maybe only 1 or 2 rate cuts is priced into the market. And the big thing you also have to point to is the Federal Reserve does not control longer rates, and especially the 10-year Treasury. Now, we can talk about everything that's going on in the White House today, you know, in all the uncertainty. But one thing that's been pretty clear, if you follow Scott Bessent, the new Treasury Secretary, is he is hyper-focused on moving the 10-year lower. And how do you do that? You do that by issuing less 10-year debt. And just as a rule of thumb, the 10-year is highly correlated to where mortgage rates sit. So, you know, when I do look at this, look, inflation is not completely solved. You look at it, the 10-year is still a little bit elevated. So in some ways, though, it's good because when you get really low interest rates, a lot of crazy things do happen in the market. So what I actually like about it is fundamentals matter a lot more when you have a little bit higher rate. So I would put this in, if I'm going to say glass half full, rates are still coming down a little bit. You know, generally rate cuts are good for stocks, but they are going to remain higher than they've been. The last one, and this is the most important when I look at the stock market, is how are profits growing? And here's the good news. We just wrapped up 2024, and this slide's a little dated. We actually had a really good earnings season. Earnings grew over 10% last quarter to end the year, and it was 10+% earnings growth for the S&P 500. And if you look historically back to the 50s, guess what? The average EPS growth or earnings per share growth on the market is 8%. How much does the market go up? It goes up 8% a year. Now, people get excited and lose faith, and the price you pay for stocks does change over time. But here's the key, is the fundamentals really do matter. So if you look, and it is actually quite extraordinary, with all the craziness we've been through the last 5 years, you look at the COVID low of $135 per share on the S&P, where we touched record profits of $161 in 2019. We are so far above that. We earned about $240 in 2024 in earnings. And you look at it, next 2 years, 10+% growth projected. Now, projections can change. It doesn't mean we're going to earn that. But when you see that, if we can continue to get good earnings growth, stocks can continue to move higher. So this is definitely a plus in my camp. And just to bring it back to the financial crisis, which was terrible for the U.S. economy, you look at it, 2006, the S&P 500 made $100 per share. It took us all the way to 2012 to get back to where we were from a profitability standpoint. This time around, you wonder how the market has done so well. It's really been the fundamental that has driven this market, and that is the more medium-term driver. Now, that is a positive, but I will say, I did say at the beginning, this is a little bit of a mixed bag. So one thing to always know about the stock market is it is an expectations game, right? So if you have really high expectations, you have to hit a really high bar. One thing that we have seen as of late, and we track very closely, is how are earnings expectations changing? And as of late, especially in more cyclical sectors, for this year's profits, we have seen them moving down a little bit, and quite a bit actually over the last couple months. You know, I do think there's a lot of uncertainty out there around policy these days. I would actually say, hey, if I am a CFO of a publicly traded company today, you know what? I don't know what my tariff impact is going to be, so maybe I'm going to guide a little bit conservatively for my full year profits. So that's the glass half full view, but it is worth pointing out. Look, you've had some mixed data lately. Consumer sentiment was pretty weak today. What's been interesting is more the soft data, as we call it, on Wall Street, which is more like surveys and not the hard data, has been weaker as of late. But the hard data is still pretty decent. So I would still say, this market, there is room where it could still move higher. But here's the key point. The market, as Morgan and Brian showed you with one metric of GDP, how expensive it is today, the most basic metric we look at is a PE ratio. And by pretty much any measure, the stock market is expensive today, which just means you have a higher hurdle to get over. So if I had to look out 3 to 5 years, do I think stocks will be up? Probably, but I don't anticipate the same gains that we have seen over the past 5 to 7 years. All right. I will talk policy for a minute and the new administration. Obviously, a lot to unpack there. What I would say is, look, you looked when President Trump won in November, the market did tend to price in a lot of what I would call the goodies, right? Deregulation, generally good for the market. Cutting red tape is good for the market. Generally, tax cuts, good for the market. You look at, global M&A, companies getting acquired. It should come back under President Trump. What I would say is, as of late, what has gotten priced in is a lot of stuff we knew about, but we weren't as focused on, and that's tariffs. That's deporting, right? What's that going to do to our labor force? So when you do look at some, and just his off again, on again policies, the market really just does not like uncertainty, and you are seeing some of that. But I would say generally, and this is my house view, is we tend to focus too much on politics with our investments in policy and too little on fundamentals. So I always show this chart. And this chart is just a chart of the orange line here is clean energy stocks, right? So think of your EV makers, think of your solar companies and their return over time, and compare that to the blue line, which is traditional oil and gas. And so if you look at this, you think about 2020, 2024 with under President Biden, look, we had the Inflation Reduction Bill, which was really a green energy bill. Like, green energy stocks did horrible, right? And then under President Biden, traditional oil and gas stocks did really well. And the big reason why was fundamentals were terrible for green energy stocks. They didn't make money. Interest rates were higher. And then you looked at oil and gas stocks, they actually got religion about returning cash flow to investors and making more profits, and they did extraordinarily well. And you could say the same thing from 16 to 20. What was not a good investment at all was traditional oil and gas. And traditionally, a red White House is viewed as a good thing for oil and gas. So I would just say I would discount a lot of that narrative out there and just more focus on those fundamentals in the market. But with that said, I do think it's worth diving into this market, because this has been one of the most extreme, narrow markets we have seen in a long time, where diversification, hallmark of investing, has not been your friend. And if you look at just the last 2 years, 2023 and 2024, if you took every stock on the S&P 500, those 2 years, only 27 and 28% of members beat the benchmark. Why? Because the Mag 7 and a few other tech names dominated the market return. Now, what's interesting is if you look at history, these were the most years that we have seen since at least 1995. And over time, if you look at the blue bars here, I'm not telling you that the market's going to widen hugely out overnight. I can't tell you when that's going to happen. But this does tend to go in cycles over time. But just to show you, the last 2 years have been extraordinarily unique. Year to date, if you actually bought a basket of like equally weighted stocks, so not heavy at the top, you're actually up to slightly down for the year, right? If you were totally invested in just big tech stocks today, you're down 8 to 10%. So we've actually seen a reversion so far to start the year. But just to show you, it has been an extraordinarily narrow market. And here's the good news. I didn't share this. I should have shared this a minute ago. The market is expensive, but the average stock isn't that expensive if you look across the whole market. So if you look at mid caps, they talk about adding mid cap positions. You look at large caps, The average stock is slightly above where it historically trades, but it's not crazy expensive by any measure. And just when you look at this market, look, reversion to the mean is a powerful thing that does happen over time. Now, I look at companies like Amazon, Microsoft, Google, Apple, best companies in the world, highest quality names. The problem is they're just very, very expensive today. And it doesn't mean you're going to go out of business or anything like that. No, I think they have some of the biggest moats you've seen. The problem is a valuation problem. And just a little bit of food for thought, you look historically, it's really hard to remain one of the biggest companies in the world. Go back to 2000. General Electric, one of the biggest companies in the world. Huge fall from grace. Microsoft's still there. Walmart's there. But you look at a name like Intel. Who would have thought NVIDIA graphics processing or GPUs would be change the whole world with AI 25 years ago? Not at all. One of my favorites is you go back 25 years. I'm from Chicago. Lucid Technology was a Chicago-based tech firm. One thing you should know is you never invest in a technology firm from Chicago. I'll give you that investment advice. Doesn't work out. Seattle-based, a lot better. But just to show you some of these names, AOL Time Warner, probably one of the worst mergers of all time. If you look at it, it doesn't mean these are amazing companies over here. I'm not saying it's hard to handicap where they're going to go. But where the puck is going today is it's been an extraordinarily one-way trade, and now you're starting to see some of that reverse. And if you look at the S&P 500 today, look, 5 names make up about 25% of just that benchmark. You're not getting a super diversified portfolio today. And plus, it's been fantastic. I'm not going to say it hasn't, and it's been the right place to be. You look at the S&P 500 today, that broad-based benchmark, actually about half your weight is in the technology sector today. So it's this crazy market where diversification hasn't been your friend. And the last 2 years, you wanted to look as much as like you can at like these big names. And then year to date, that is completely reversed. But some of it does make sense, right? When you look at good quality names, great companies, but the average PE you're paying is over 30 times earnings. But you've just seen so much dominance at the top of the market. And here's what I would say, but you could say, but Chris, these companies are the most quality companies in the world. They're great. And I agree. But we do like this broadening out trade, whether that be smaller, large caps, or whether that be small and mid caps with a quality bent to them. We'll touch on that. But I'm going to show you the same chart I showed you at the beginning, and it was the EPS of the S&P 500. Now what I've done is I've broken out the Mag 7 and the other 493. And what you've seen, remember I told you, fundamentals drive this market. You look at the last 2 years, who's grown earnings the most? Mag 7 names, 20% and 35%. Great growth rates. You look at the other 493, so the other 493 in the S&P 500, still big blue chip companies, they've actually had pretty flat earnings growth. But here's the thing, the setup going forward is really good. And so we have a term in this industry called comparables, or just think of a low bar versus a high bar. Why you've seen some weakness as of late is because the Mag 7, just to hit expectations, remember the market's an expectations game, needs to grow earnings by 20+% in each of the next 2 years. That's what the market's pricing in. The other 493, think of it as falling out of your basement window, has much lower expectations, so they can surprise the upside. And it's easy to forget. Now, AI has been a big contributor to this, obviously, but it's easy to forget in 2022, big tech had a bad year. Why? The earnings weren't great. And one of the things I look at is just a valuation gap. And you can see today, Russell Top 50, this has come down a little bit, tech index, but the big tech names trade close to 30 times earnings, where the equally weighted index trades at a much, much lower multiple. So we like this trade. And so one way to do it too is you just forget there's really good companies that aren't just the big tech names. Now, big tech names, like I've said multiple times, are great companies, but you look at the top 10 names in the S&P today, 38% of the weight, average PE ratio of 30. Look at the next 100 names in the benchmark, about 20 times earnings. Look at the smallest 100 names on the S&P 500 today that are still large caps, and if you buy the S&P 500, you only get about 3 cents of every dollar in. you hardly get any weight there. So there's still good opportunities down here. Now the problem is, and this is, and I won't get into too much, is up here. These are the best companies in the world. These are still good companies. They're just not quite as good. So you do need to put some fundamental screens on top of what you're doing there. And I'm sure Morgan and Brian are doing that with whatever they're doing. But that's key. And then I'll just briefly touch on small and mid cap. Look, the opportunity is here, right? You look at the PE on mid cap, it's 18. You look at the PE on small cap, it's 18. The problem is, profitability wise, it's just not as high. They're not as good a company. You look at the median ROE, just how much money do you make on your investment? For small caps, it's 4 to 8%. Large caps is 16%. You give up that quality when you go down cap. So we love this widening out trade. We think that there's opportunities because the valuations are so much more reasonable, but you got to be careful because you're not buying as good a companies. And just touching on what I touched on a minute ago, look, you look at earnings expectations, guess what? They've held in there for large cap. They've come down in small and mid caps a lot more. So be selective, but there are really good, reasonably priced names in this marketplace today. So I'll end with one more slide because this is my favorite slide in the whole deck. Look, when you look over time, it pays to stay invested in the equity markets, the stock market. This is the annual returns of the S&P 500. What should jump out to you right away is that stock market does tend to go up 3 out of 4 years on average, last 100 years. Now, does that mean I know what's going to happen this year? Absolutely not. But I would say is like we want to stay invested, but I love what Morgan and Brian were talking about as staying diversified and fitting your risk tolerance. Because I would actually argue there's probably a higher chance of having a down year than we've had. And I think that's why you've seen some volatility to start the year, right? This market's the most concentrated market at the top that we've seen since the 1930s. It's also the most expensive market if you do a market cap weighted index that we've seen since the late 90s. And you're just not getting that diversification. So is there a higher chance of this? Absolutely. But over time, it does get paid. I can't tell you what's going to happen to the equity market tomorrow or next week. But if I had to bet 3 to 5 years from now, I would say we're going to be higher because we're still the greatest economy in the world. We're still growing profits. But I will leave it there and turn it back to Morgan and Brian.
Thank
All
you so
right.
much, Chris.
Go ahead and stop share. Now there is a chart in there I was hoping you would cover, but no worries. And it's the market cap weighted annual factor returns versus S&P 500. And really my question, and we'll talk about it later, is are we seeing a value pivot? But let me go through a couple things here and then we'll go to Q&A later. So for those of you who are, sitting in this webinar and you're feeling, holy cow, that's overwhelming, I'm really worried about things, and you want to talk about, are you positioned properly? Are you in the right strategy or strategies based on your situation and everything going on? Feel free to reach out to us. We're happy to talk. If you want to go through a plan update, to reverse engineer, what is your required rate of return so that we can determine those, we're happy to do that. All three of us are available to do that. Our contact information is below, as well as we'll have Kelsey's contact information at the end of this presentation. Now for some fun stuff, before we go to Q&A, we have some upcoming events. For those of you who are in the Bunko Club, or the Impact Club, excuse me, we have our Bunko game night. That's going to be at the Two Vintners Winery in Woodinville. Now, don't worry, we've already sampled the wine and it passes. It's very good. And we decided let's move that to May when it's a little nicer out and we can have the doors open. So, it'll be a beautiful May day, let's hope. So that's on Saturday, May 10th from 6:30 to 9 p.m. If you haven't played Bunko, kindergartners are capable of playing Bunko. So you've got this, because I've talked to a few clients and like, I don't know how to play. It'll take all of, what do you think, 30 seconds, Morgan, to learn how to play Bunko?
It's a fast and easy game.
It's really fun. It's for such a simple game, it is surprisingly fun. I assume, Chris, you've played some Bunko in your life at some point.
My wife has played a lot of Bunko. I've actually never played.
You're a Bunko avoider, huh? Yeah, it's a lot of fun. So something new we're doing this year is we're going to do a shred event. That paper adds up. So if you want to come by, we're going to have a shred it truck right out in front of the building here. That's going to be on Saturday, June 7th. Now, knock on wood, everybody. Let's hope it's not raining that day. And we're actually going to be doing an e-cycle event for those pesky electronics that add up that you don't know what to deal with. Bring them by. We're going to be able to dispose of those for you as well. And then the last thing on the upcoming events, now this is a ways out. On Thursday, October 9th, we're actually going to be doing an event. It's going to be at the Edmonds College Black Box Theater. And this is going to be the first time we're doing a TED Talk style. So Morgan will be presenting. He'll be talking about markets. Who knows between now and then what that looks like. Stay tuned.
Different.
But we're going to have a special guest speaker. His name is Dr. Mark Milstein. Milstein, okay. And he's actually a healthy aging expert. And he's in particular talking about healthy brain aging and things you can do to avoid dementia. So if you're interested in attending any of these events, grab your phone, scan that QR code. It'll take you right to our website where you can RSVP. And so with that, let's go into the Q&A part here. Now, I had a bunch of questions, but I want to leave it to the audience first. And these questions are for Chris. I get to ask Morgan questions anytime I want. All right. So where are the questions? Oh, here we go.
I got it up, Brian. Do you need me to read it for you?
Yeah. So isn't it true the budget deficit tends to increase more under Republicans than Democrats? If so, what does that imply about uncertainty? Does it make it more likely to see an increasing deficit?
Yeah, I mean, I think if you go back to like fiscal conservatives, I don't know when, like, I mean, George Bush Sr. said, "Read my lips, no new taxes," and he raised taxes right to was that the 90s. And ever since then, I think it's you know, I know Bill Clinton had a balanced budget, and but I mean, you just look at the last few. I mean, it's been, you know, Obama spent a ton, Bush spent a ton, Obama spent a ton. Trump spent more, and then I mean the Biden spending was off the charts, and you guys did a good job of showing just how much even the deficit. You know, you extend tax cuts, the deficit's going to stay really high. So, and I think it's just I do like the idea behind DOGE, just that we do have a lot of waste in spending. Now you could, you know, obviously we could talk about how it's getting implemented, because I think, you know, either way, these budget deficits aren't sustainable for the long run. I mean, I think that's why, though, I think, like, obviously, you can say what you want, but Cent, I think, is actually doing a pretty good job of trying to keep the tenure down, but not issuing too much. But, you know, what I would pivot to is, look, this is an issue, but it's not a near-term issue. We are still the standard that people are jealous of that will come, and you will still issue debt to the U.S. And buy our bonds. And then the other thing is, you look at our corporate balance sheets, they've never been stronger. Like, I will joke that, like, Apple has a better balance sheet than the U.S. government. It's true. But, like, when you do look at it, it does matter. The reason deficits matter is because it means interest rates aren't going to go extremely low. That means you have to buy good companies that have good balance sheets. But the good news is the U.S. corporate sector is still doing really well. So I think that can get lost sometimes. But, yeah, I think my point is I don't know who's everybody's spending a lot. It doesn't matter if it's red or blue. And at some point, we need to do something else.
Yeah. The one comment I'll make about deficits is, you know, unfortunately, deficit spending is typically a market positive, because one person's spending is another person's income, and corporations tend to benefit from government spending. So if you want to see valuations go up and earnings go up, government being overly generous is a good way to see market valuations rise. If, you know, DOGE or efforts like it succeed and you see lower spending, it might be actually market negative. Now, not necessarily economic negative, but could be market negative from that standpoint. So I said, yeah, be careful what we wish for as investors. As an American, I would like to see us get our fiscal house in order, because I believe that it's an eventual problem, whether it's in 10 years from now or not. I plan to still be here 10 years from now and have adult children at that point. And that's a concern for me longer term.
Well, as I've said, it's never going to be popular. And if we keep the can long enough, it will just be even more onerous and awful and hated even more. It just never goes well, period.
Yep.
So I have a question here, and that is, what's driving the earnings growth? You know, for a long time during COVID, it was pretty obvious, right? We had all the stimulus and record low interest rates. That was a pretty simple recipe. But we're long after COVID, and we're continuing to see this earnings growth. You were showing there from 24 to 25 that it was actually a 12% earnings growth expectation. I was doing the math while you were speaking.
Yeah.
Where's that coming from? Consumers seem pretty squeezed right now. We've got $1.1 trillion I saw this morning in credit card debt because people are bridging this inflation gap, right? This income gap with credit. How are these corporations making so much money with rates higher, stimulus is gone, inflation squeezing their earnings?
Yeah, so one of the hard truths is the top 10% of consumers today drive about 50% of spending. So whereas the bottom half of Americans are really struggling, they're not the ones that drive the economy. It's that top quartile of Americans that are doing quite well. And you think higher interest rates? I'm sure you see it in your client statements. Like you're actually getting interest income for the first time with bonds and money markets that you've gotten in a long time. So I think that's a big part of it. The other part of it is we are so innovative, right? We have had, you think about productivity growth and what's going to come. Now, I think I would argue that there's a lot of wasted spending with this AI build out. But at the end of the day, I'm sure many on this call are starting to dabble with ChatGPT or use it in their workplaces. And it is going to improve U.S. productivity. So really, we've had a resilient consumer, and then we've had this huge uptick in AI CapEx spending that has really goosed the U.S. economy.
Yeah, interesting. Right, we got another question here in the queue. It just came in, and I'm going to paraphrase. I hope the client doesn't mind, but the question is around the foreign policy relations and whether some of the Trump policies like tariffs are antagonizing our trading partners, and whether that's going to have potentially, or if the market has priced that in, and whether the market has priced that in. I'm going to say not yet. I think we've seen some volatility as a result of it. For one, we don't really know what final tariff policy is going to look like. Next week, they're expecting to have a pretty big release about tariff announcements on the European Union, for example. And we don't know how long they're going to last. You could have 100% tariffs announced today, but if they're taken off tomorrow, they're not really impactful. What I'll say about tariffs, and I've told a few clients privately this, is tariffs will matter if they are high and remain on for an extended period of time, to the point where they start impacting things like company revenues and cost of goods sold and all of those pieces. And we're not going to know that for a while, unfortunately. So I would say there's potential for both. Will it matter? Well, it might not, but it also might if it's high and stays on for a lengthy period of time. That actually really impacts trade. And again, that's that dip on my chart I was showing earlier. Like we're going, even if it succeeds, you're probably going through a period of slowdown, economic slowdown with higher prices.
Yeah, and I think I would just add, like, the market loved it yesterday when they talked about being more targeted. Right now, these blanket tariffs. So I completely agree, Morgan. It is not completely priced. It's just like I'm exhausted by it. That it's really hard to handicap. But at the end of the day, I think the only thing Trump probably cares more about than his golf game is what the stock market price is. And when you start getting 6 to 12 months from now, we start talking about midterms. He doesn't want to see a down S&P. So I think it's the art of the deal for him, and I don't presume he's going to want to sink the U.S. economy.
Yeah.
So I want to chime in on this too. I listened to because I figured I got to brush up on tariffs, and the guy who I was listening to said that the reality is that tariffs are about this big of the problem, and that we're using tariffs, or Trump's using tariffs, as a way to actually remove trade barriers. That's the bigger issue. So a lot of these countries that we're trading with don't necessarily have high tariffs, but they've put in a lot of protective barriers, meaning that they're protecting their companies from foreign competition through different trade what they call, I have it on my other screen here, technical standards and regulations, sanctions, import licensing, complex custom procedures, all sorts of stuff that just makes it difficult for us to import goods to them. And so I think tariffs are just sort of I call it a shock and awe campaign. I love Mike Tyson's quote, everyone has a plan until they get punched in the face. This is the punch in the face, get them on their heels, get them to come to the negotiating table. And my full expectation is that it ends up being tariff neutral at most. It's going to be the trade barriers that are actually going to be the thing that's going to be changed.
Yeah. It'll be interesting to see how it plays out in data, which is what we're going to pay attention to for our active models.
Yeah.
Brian, we're at time. I believe we're very close to it. Do you want to ask one more, or should we close it up?
I did have one more, and this is a bigger question. But I went through your slide deck ahead of time. Thank you for sending that. And I was just kind of piecemealing some stuff together. So while I'm not concerned about the market now, there's sort of a setup that I see, and I'm just curious what your opinion is. We've been hearing all about the zombie companies, right? Last stat I saw, The Russell 2000, for those listening, that's the small cap index. I think it was 43% of the companies in the Russell 2000 were zombie companies. And for those who don't know what a zombie company is, they spend more in debt service than they actually make in profit. And that's on debt that was issued back when debt was cheap. Since then, mortgage rates have gone from 2.75 on mine to 6.75 on a new one. That's going to apply to these companies. And what you had in your slide deck was the maturing debt that these indexes, the Russell 2000, is going to be facing starting in 2026. I think it was a tune of 60-something% of those companies are going to have to refinance debt. Well, if 60-something% of the index is doing that and 43% of the index isn't profitable already, what happens? What's that look like? Is that a concern to you guys? Sorry to drag the future into the present so much, but that was the one that really jumped out at me.
Well, I got my crystal ball right here.
So I will say you have to be selective. So there's been a change, not to get too much into Wall Street speak, but like in market structure. So it used to be companies would come public as small caps, right? Now the private markets are really, really robust. So that's why you'll see a company like a Stripe that might come public at some point, come public as a large cap. So as you go down to smaller companies, you give up, they're not as quality as they were 20, 30 years ago. So like when I'm always talking about small or mid caps, is you have to be selective. There's a lot of really good companies and here's the truth. There's a lot of companies that are cheap for a reason. That's not what you want to invest in. That's why you want to, now, but I do think there's still a lot more companies than 7 companies. There's 7 really good companies, right, that everybody's talked about for the last 3-5 years. There's still a lot of other really good companies that are almost as good that trade at a lot lower valuation. And that's where I'd be tilting towards. But yes, is there a concern? We have a very robust capital market system in the U.S. So if we get a recession, look, a lot of those names aren't going to make it, right? And part of that is, I should say too, you look at small caps, a big chunk of that is healthcare names within the biotech industry. Historically, how those work is you come up with a drug, you get it through trials, and maybe your drug works or it doesn't. So you either go bankrupt or the stock's going to go up 1,000%. So you do have to handicap it a little bit. It's a different basket of names. But yes, it is a concern, and that's why you definitely have to be selective when you look at smaller names.
That's interesting. We are in a biotech area, and you've seen a lot of consolidation lately. So that makes sense.
Yeah.
So we got one here talking about the forecast on the 2026 and 2027 earnings that you showed, Chris. And the client is questioning, are we being overly rosy with such what seem like strong projections into the future of strong earnings?
Yeah. So I should have said this at the beginning. Those are what the Wall Street expectation is. So if you take all the analysts you see on CBC that says, I got to buy on this stock and this is how much I think I can earn, it's the aggregate consensus. So here's generally what happens. It's usually a little bit conservative if we don't get a recession. If we get a recession, generally the numbers are way too high. So yes, if let's just say, Trump puts 100% tariffs on everybody, we go into recession, those numbers are going to be way too high, right? But generally they're pretty accurate as long as you don't get a recession.
It's Wall Street's best educated guess. I'll put it that way based on recent behavior, which is, recency bias, as we all know. So, there are any number of things that Chris was saying that could derail that. And that is the point. That bar is really, really high. And so you could see disappointment, which leads to lower stock valuation. So something to be mindful of, especially in the highly concentrated positions.
Well, we're at time, Chris. Thank you very much. And we will we'll see you this evening in Bellevue for the second round.
Looking forward to thank you everybody for jumping on today.
Yeah.
And if you guys have any more questions, feel free to reach out. We're happy to help.